Well, let me also take it across to Ruchir Agarwal, Director of Finance at Mazagon Shipbuilders, joining in on the show right now. Ruchir, hi. Your Q4 profits have seen a decline of about 54%. What were the key factors that impacted profitability despite a revenue growth?
We have reported 51% dip in our profits in comparison to last year. But there is a growth of almost 20% as far as revenue from operation is concerned. And this dip is primarily due to booking of our probable losses in two of our contracts. What we expect we got in a competitive bidding. One is for the Coast Guard and another is for the Denmark export contract, where when we bid and the situation has changed, the marine dynamics have changed, and there is a lot more orders to be executed by foreign vendors. So they are the price what they quoted at the time of bid, and now at the time of supply, we are finding that all the items are on a higher side. So that to be on safer side, we have booked the losses as per the accounting standard 37. And we will be seeing how to reduce these losses as we go close to the completion of contract, and we will be charging those exact losses to the P&L and see how the things progresses. But as far as EBITDA margin are concerned, on year-to-year basis, we are still better than last year. We have reported a EBITDA margin of 28%, around 28% against 26% what we reported last year. But yes, due to making a provision of around 532 crores this quarter, our profit for this quarter has dipped by 51%.
So EBITDA margins dropped significantly this quarter. Is this a temporary blip or indicative of long-term cost trend?
No, as per India's 37, we have to book the maximum amount of loss. I don't think the losses could be on this high range in future quarters, but we will be assessing the position every quarter, and then based on that, the entry will be coming. But I don't think major entries will be coming in future quarters because we have already assessed the position and booked accordingly.
But could you break down the impact of the input cost and execution delays on this quarter margins for us?
We are not booking any LD provision this quarter. We have already made a 120 crores provision for ONGC contract last quarter. And there is no major LD provision for this year. And we are geared up to complete our contracts on time so that we save on time as well as cost and application of LD. So our management is fully focused and we are trying to deliver all our contracts on time. Or our emphasis is that we try to complete before time.
Right. And what's your revenue and margin guidance for FY26?
We had always been saying that in this industry, our margin should be in the range of 12 to 15%, and that is ensured. And the high margins which we saw in previous 1 or 2 years was due to conclusion of the contracts, and we were able to negotiate better in those fixed price contracts, or the margins were good. But in the industry, the standard margin is around 12 to 15%, and we expect to be earning those margins at that time.
Right. So your current order book stands at about 32,000 crore. How much of that is executable in FY26 and 27?
Major order book will be towards the delivery of our 17A3 boats, which we have to deliver to Navy. And earlier we expected that the third boat was to be delivered in August 26, but now we are gearing up so that can we deliver all the 3 boats in this financial year. We are making all the efforts that we could conclude those boats this year.
But if you can help us understand which major projects are contributing most to the order book right now, and what's the expected delivery timeline on the same?
We expect that all these orders are expected to be completed by 26-27. But we expect that by the time we will be executing these orders, we will be getting new orders. Already, Government of India's focus is on making India Atmanirbhar Bharat, and with this Operation Sindoor, our defense PSUs has already established their presence and capability in the world. We expect that we should get export orders for what we demonstrated. And also, with the growth of Indian maritime industry, particularly our government's focus on Atmanirbhar Bharat, we expect that we should get more orders in for non-navy commercial contracts in years to come.
Right. And how is the government's increasing defense allocation translating into actual business for you? And how much is your order book now from the government directly?
It is all strategic decision by Government of India, and out of the total allocation, how much they are allocating towards the Navy allocation, and further that on those Navy contracts, how much is coming to us will be more crucial. And we expect that we should be getting good number of orders from Navy, because we have made good boats for them, and they also acknowledge our capability to make in India a world-class boats for them.
P751 submarine project or the next gen destroyer, what is the update on that?
We are already expecting these orders to come anytime, and because they have been finalized, but only we have to receive them orders, and we expect that all the 3 follow-on orders and 75I orders should come very soon, so that it makes our order book healthy, and our we are again back to submarine manufacturing, which presently we are not.
Lastly, are there any capex plans underway to expand the dry dock capacity or modernize the production infrastructure?
In a way to increase our DWT to 2 lakh tons DWT. And for that, we are going for a big capex plan, one at Nava, which is nearby, and also the South Yard, where we have taken the land from Mumbai Port Trust. So we are going, we have already lined up the consultants, and based on the consultants' report, we will be expanding our footprints there, and capacity footprints along with our capacity for making new ships.
All right, Mr. Agarwal, with this we let you go on that. Thank you so much for taking the time out. Pleasure speaking with you.
If you like this video, then like, share and subscribe to ET Now.